Good morning, I'm Bill Hubar, Chief Economist at Trade.com, and welcome to our weekly market analysis here on Core Finance. Now, we have our guest here this morning, Mike Ingram. And Mike Ingram, what exciting news do you have for us today, young man?
I am Chief Market Strategist at WH Ireland.
Welcome aboard. Thank you very much. And I hope, I see you got your new haircut and everything all ready to go.
Unfortunately, not new hair from certain angles, but
well,
one does one's best.
You couldn't be starting a new job at a more important time. Last night we had the Federal Reserve, okay?
Yeah.
Today we have the Bank of England, everybody getting ready, especially probably 80% of the people here in the city saying, Grandma, what does a Bank of England rate increase mean? And then, of course, tomorrow we have the usual non-farm payroll. So let's start with last night's FOMC meeting. Your thoughts?
Well, the market thought it would be a non-event, and it largely was a non-event. And it's quite interesting, to see the expectation going in was only a 10, maybe 15% chance of a hike this time around, but a 90% chance of a hike in December. You don't normally see that jump, that massive jump between meetings. So, but yeah, so far it's on script. Fed very much reaffirming its view that growth within the US economy, if not spectacular, remains robust. I mean, the language changed from a moderate pace to solid growth. Obviously, they had to take on board the disruption and the volatility that hurricanes and so forth have introduced into the macro data, and of course we should see a big flip on the non-farms tomorrow on the back of that. So the market feels very much reaffirmed that we are going to see that third rate hike in December, but of course, there's a lot of moving parts going into 2018. Dot plot's still 3, but what Fed are we dealing with is the issue.
And what moving parts are we talking about? Because as everybody was expecting, they were looking over Janet Yellen's shoulder last night for what will probably happen today. And what are your thoughts on who will be the next Fed chair?
Well, you're asking me to predict what Donald Trump's going to do next, so I'm probably on a hiding to nothing here. What I can say is the so-called smart money at the moment is that Jerome Powell will be named as Fed chairman. He is thought to be very much a similar quantity to Janet Yellen herself, maybe a touch more hawkish, but in no way could it be characterized as a hawk. He's probably a little bit more in favor of financial deregulation.
I think that's probably the key word.
Yes, that's tipped. But we got Randy Quarles in place as well as the in the position for financial regulation. So I guess it's Janet out in February next year, which would leave 4 seats
right.
On the Fed Board of Governors free. So the question is who's going to fill those slots, and it seems to be a real mix. I mean, John Taylor, maybe he's going to get chair. He's been talked about in terms of vice chair. It'd be strange if he doesn't get chair or vice chair that he's not on the board. So he's on principle he's very hawkish. Because he was he formulated the so-called Taylor rule for interest rates back in 1992, I believe, and his rule at the moment suggests that Fed funds rate should be somewhere north of 3%. So I think I can safely assume that were you on the board, that would be hawkish dissent at the moment. Are we going to get Marvin Goodfriend on? Are we going to get Kevin Walsh? I mean, they both tend to be sort of on the hawkish side, and in and around that, the usual rotation of regional Fed presidents is going to tilt more hawkish anyway. So it's great. We have this dot plot out there. The market isn't buying 3 hikes for next year anyway. I mean, we've delivered on those 3. We're pretty sure they're going to deliver on the 3. For this year, for the first time ever since the dot plot existed. But they're buying 1 rate hike for next year at the moment. 1 rate hike for next year out of 3 for the dot plot in terms of 2019.
Well, let's look at a major chart, okay?
Yes.
The key thing here is we're talking sterling dollar, and we can talk about the Bank of England. But as we saw here, okay? Now, if you saw this move down here, basically, people were talking about Taylor becoming the Fed chair, and you saw because him being, as you said, far more hawkish, okay? So therefore, everybody, the dollar woke up after being, comatose for 6 months, and then we saw that, and then as you just said, it sort of moved back to Powell, and also the simple fact is people beginning, and I think we're only a few hours away for. Do you remember March 2007?
I was of working age in 2007. It's see, this is the thing. Donald Trump isn't an ideologue. I don't think he's got an ideological bone in his body.
No.
So candidate Trump was very much against low rates. Very vocal against Janet Yellen and saying, well, it's a conspiracy between the Fed and the Democrats. She's doing Obama's bidding, and that's why the Fed is keeping, easy money, etc. And you could say, right. So I actually at some level I sympathise with. I think keeping rates so low for so long has actually done lasting damage,
I do too.
not just to the US economy, but to the global economy.
Yes.
But moving on, but if you say, well, that's what he believes, and his nominations to the Fed board will be framed around that ideology. Well, now it's President Trump. Now he's actually the person in the White House. Well, now he likes low rates. Quelle surprise. And Janet Yellen, is a proponent of low rates, and Jerome Powell, who's the favourite to be the next Fed chair, likes low rates. But he also kind of still likes John Taylor. He likes the more rules-based approach. So it could be a real mismatch. Yes, we have in principle probably going to get 4 vacant seats on the Fed board by February of next year. That's 4 out of 7. But the idea that he's going to pack it full of doves or put full of hawks might be mistaken, because at the moment there's no consistency. Well, there's as much consistency with his choice of Fed candidates as pretty much anything else, I'd have to say. So, but yeah.
Because I mean, as you see here, okay,
Yes.
basically forgetting, the dollar move. Ever since, again, at least when we get the GDP numbers and the inflation numbers, et cetera, we've really gone up to, we're flirting now with 133. Market feeling today, we are going to, I think the last I looked, it was like 97% that we were going to get a rate move today at noon. But the key thing is going to be, the 2 things people are looking at. What is the vote going to be? 7.2 or 6.3? And we get the quarterly inflation report. So again, we all know that Carney has to, no question about it, has to raise rates today to keep any street credit at all. So how much of that do you think is today's move is already in the market?
I think it's as you alluded, it's very much priced in. And look, if they were, let's be honest, if they were to walk back at this stage, we've been led up the garden path so many times on this, and it's just one of the reasons why the Bank of England over the last few months has had to work so hard to get the market to finally believe that it's something they're going to do. In terms of the vote you mentioned, I think the single most likely outcome is probably 7.2, because if you look at the statements from MPC members, it seems to be that John Cunliffe and David Walsh seems to be a little, not David Walsh. I think there's going to be dissent from 2 members, basically. That seems to be the most likely. So if it's 9-0, I think the market will take that as a big push. But I think the single most important thing is it's not this rate hike today. Yes, it's significant because it hasn't. We haven't seen one in over 10 years. But it's whether or not the rate hike for 2018, which the market is now fully discounting.
Yes.
Are they going to lean against that? And the best part of another rate hike in 2019, are they going to lean against that? Now, I think under certain circumstances, they might want to do that. But I think given the track record, as I said, having fought tooth and nail to get the market on top of this, they might be very reticent. And it'd be interesting to see whether they feel that, because of course, their forecasts that we're going to see within today's inflation are going to be conditioned on money market expectations and where interest rates are going to go. If that is sufficient to bring the inflation in the UK back to the 2% target within the forecast horizon, and let's be honest, this is the first time we're going to see 2020 forecasts as well from the Bank of England.
2020 means we'll have Brexit or something.
Well, look, I think this is the thing, but I think on Brexit, as we were discussing it off air, I think anything that they say about Brexit, is going to outrage probably roughly half of the UK population. But it is the biggest single swing factor, and we'll probably have tweaks up and down in growth and inflation forecasts. But at the end of the day, what the sort of economic impact that Brexit might generate is an order of magnitude above any of these adjustments we're going to make today.
I guess most people that I talk to have gone away from the one and done, feeling that worst case scenario would be 6-3, but the consensus seems to be 7-2, move today, and possibly one move next year and nothing for 2019. That would be based on a 7-2 and looking at the economic data. But as you just said, really the catalyst is Brexit.
Yeah, I mean, I think, just on the numbers that we've already seen from the UK economy, we know we had a disappointing first quarter. We only got 0.2 Q-on-Q growth. Second quarter was in line, 0.3. The preliminary that we've seen for Q3 has been 0.4. So they'd say, well, there seems to be a bit more renewed momentum in the UK economy. Therefore, do we just kind of leave the growth forecast for this year alone? Do we actually perhaps even edge up our growth forecast marginally for next year? But do we take it away from 2019
yes.
and
Are we
beyond?
borrowing from the future?
Yeah, I mean, I think it's like you're talking about 0.1s up and down. I think you're likely. Obviously, they're going to have to up their inflation forecasts for this year because we kind of already got those numbers in. They might say, well, look, we've got higher market rates. That's going to bear down in inflation next year. You've got a higher starting point. Is it a wash trade? Are they going to keep it, maybe 2.5% was their last forecast for inflation next year? And crucially, 2019 and then going to 2020, is it going to come down? So the previous forecast for inflation 2019 was 2.2%. Now, if that comes down to 2%, that's basically saying that we think the market is currently where it needs to be, and we will see another rate hike next year. By the way, the only other overlay I would mention is that, and I know this doesn't factor into core inflation numbers, but you are seeing the sterling cost of things like oil,
yes,
etc. Because trade-weighted sterling, it's been quite volatile since the last inflation report in August, but it's basically flat. But you see, I think there's something like 16% growth in the sterling cost of energy over that period, and of course that will impact the headline rate of inflation, which of course is still the Bank of England's target,
yes,
at least in theory.
Now, okay, so what is your call for today, very quickly?
So quarter point hike.
7-2?
7-2. And I think they're not going to want to row back too hard on where the market is. I think they've always got to get out of, Brexit has caused uncertainty, and they can always have the option of easing off the gas pedal at some point in 2018, and they can say, well, there was no way we could forecast it.
Okay,
right.
we've discussed two of the three topics. Okay,
yes.
Tomorrow, first Friday of every month. Okay, October non-farm payrolls. As we saw last month, we had a minus 33,000. Yesterday, we got the ADP number came in considerably stronger.
Yeah,
although
235.
It doesn't have a very good correlation record. Okay, the consensus seems to be 300,000.
Yeah.
Basically unchanged on the unemployment rate. Again, everything will be looking at the average earnings. But my call is 315. There is an outlier for Bloomberg.
Yeah.
Talking 400,000. And as we saw last night in the Fed statement, we see moderate to modest growth, and we feel only a very temporary interruption with the two hurricanes. And one of the things we're seeing, especially in both Florida and Texas, we're seeing a massive increase in road construction. You saw automobile sales, okay? Well, you got to buy a couple of 100,000, and also new housing, okay?
Yes.
Now, I know this is a 6-month lead indicator, so we're looking at the simple fact is, will this have an impact, an immediate impact on potentially the dollar tomorrow? If we get that 315,000 average earnings at +2 or +3.
I don't know, because as you say, I think the sort of hurricane activity that we saw in September, October has introduced a lot of volatility in the numbers. Certainly the market. I suspect the market will be more sensitive to a significantly weaker number, because the market's conditioned to have a big number.
Yeah.
As you mentioned, the ADP. So I think the market was looking for 200 yesterday. They got 235, and I think that included something like 63,000 construction jobs.
Workers.
We had the Fed statement yesterday saying that they upgraded the growth assessment, shall we say, from moderate to solid. We know that business investment has picked up during the course
Yes.
of this year, and that could be further underpinned, going forward if we do see these, cuts in corporate taxes, etc. So I think that the markets were going to be more sensitive to a serious disappointment. So I'm talking about 250 or less than if it's 300, 320, 350.
Yes.
I think we're in a situation now where we're probably going to, given the disruption and the volatility that the meteorology has introduced, we're probably going to have to average off September, so October, November, December before we can really say, well, what do we think is the trajectory? But it's looking reasonably good at the moment. The US economy is looking pretty solid. You mentioned the auto number, you mentioned the housing being a key point of weakness. Actually,
Yes.
activity levels have been quite low, and for the Fed, well, again, we look at the wages. I was quite interested to see that the Fed statement yesterday didn't talk about the pickup in wages.
No.
And I think that's probably a good move because there was arguably a compositional impact from the hurricane. So a lot of the lower paid workers would have got laid off during that period, and that would have helped to bump that
Yes.
number up, and it could easily unwind. So they don't necessarily want to pin their colours to the mast on that one. But yeah, it's steady as she goes. But as I say, any numbers which would further vindicate the Fed's rate hike, which again the market seems very, very certain about at this stage. 2018, the reaction function of the Fed almost certainly will change.
Well, Mike, I want to say thank you very much for joining us. Good luck with your new job,
Thank you.
and we will see you next week. Well, excuse me, next month, and I will see you all next week. Thank you very much for joining us.